Before we get into today's video, I want to share something. My Apple stock is up about 113%. Apple has hit all-time highs multiple times recently. It ended the week at $333.74, but it's almost hit $335 recently. And another investment in my portfolio, the ETF SCHD, has also hit a 52-week high. It ended the week at $32.91, and its historical high is $33.50. Some investors, new investors, might see headlines like this and think they missed their chance for investing into this stock or ETF. But that's not the way to think about investing. The stocks and funds that I've been holding in my portfolio have hit all-time highs over and over again. So today I want to talk about why that does not mean it's time to cut that investment from my portfolio. Does not mean that the growth is over. It could just be a sign that this investment is getting stronger. This video, after you finish watching this one, I'm going to tag it at the end also, where I go into a deep dive on picking individual stocks as well as the right ETF for your portfolio. But let's get into a checklist on how you can navigate investments hitting all-time highs. Number one, a high share price does not mean that the investment is overvalued. A share price growing steadily year after year, reaching those all-time highs, doesn't automatically mean that it's overpriced. And every investment that falls does not automatically mean that it's a bargain that you should load up on. These are the questions that you should be asked. Has this business become more valuable? Is the company on track to continue growing when it comes to its earnings, increasing its revenue, producing more cash, expanding and improving, making strategic partnerships? These are things that should have a company on track to eventually be worth more. So spend more time looking at the fundamentals, not just the headlines. Take some time to understand things like the revenue growth, the current PE, the forward PE. Those are things that tell far more than just the stock price moving up. Here's a look at Google, which I use as an example in a recent video. It was nearly $3,000 per share back in 2021. Before the stock split. Just looking at that number, people could have thought, there's no way that we should buy this stock. Can it continue to go higher? That share price has nothing to do with the fundamentals of this business, what it provides. So Google had a share split, and then their share price was less than $100. The split didn't create any value. The value comes from what the company has been achieving. So separate the business from the share price. Now, let's talk a little bit about how to go about navigating ETFs like SCHD in this same situation. This is lesson number 2. When you buy Apple, you're investing into just that one company. But SCHD, the Schwab US Dividend Equity ETF, gives you exposure to a whole portfolio of businesses. And this is an important difference. ETF, which has been around since 2011, holds 103 companies and has a low expense ratio of 0.06%. SCHD is a collection of high-quality dividend-paying investments like United Health, Home Depot, Coca-Cola, Pepsi, and Chevron, giving you exposure that's not heavily into tech like many other investments. This one gives more exposure to healthcare, staples, energy, and industrials. CHD, they change over time, those top holdings, keep you on track to have the best dividend-paying investments with that track record in your portfolio leading this fund. As certain companies become stronger, they'll get a heavier weighting in the fund. No longer meeting the criteria, you're going to be out. This is why ETFs are great for beginners. Could these investments have a pullback? Yes, of course they can. But my focus is being a long-term investor. And does the structure of the funds have it on track for continued growth? Is the company, like Apple, still checking all of the boxes that I originally researched before adding it into my portfolio as a long-term investment? And I believe in both of these investments, and I'm going to continue to hold. Now, let's take a closer look at my performance so far. When it comes to SCHD, I'm holding 58 shares in my portfolio. It has not been a focus for me to build up this position. I've been working on growth positions when it comes to my portfolio, but I'm still holding. and I'm currently up about 26%. Here's something that had investors pleasantly surprised at the beginning of this year. While big tech names like Apple and indices like the S&P 500 have pulled back, SCHD was up 11%, while Apple at the time was down 9%. And the S&P was down about 7%. And now, currently, year to date, Apple is up about 23% and SCHD is up about 20%, while the S&P is up just 9%. Let's move on to lesson 3. If you are going to add individual stocks into your portfolio, make sure you're ready to put in the work to keep up with the technicals and fundamentals and get the answers to questions this. Is this still a high quality business? Does it have strong leadership, strong financial, a competitive advantage? Will it still be earning more money 5 years from now? Are the fundamentals stepping up? And does the investment still fit my overall portfolio? These two investments are very different. Apple and the ETF SCHD, they serve different purposes. Apple is in my growth portfolio, while SCHD is for dividends. And yes, both are doing their job, giving me exposure to great businesses. I've been building up my portfolios for a few years now, so I've been through this. When it comes to individual stocks like Meta and Amazon and Apple, I can remember when my average cost on it was $120. Same goes for ETF. VTI, which I invested into for over 3 years straight. I was investing into it at $177 and still investing when it was over $300. So the message that I'm trying to get across here is to not let all-time highs scare you off. When it comes to a high quality investment, if you're holding for years, even decades, my best performing investments are going to hit countless amounts of all-time highs. So I'm glad that I've made the decision to focus on quality and not sit around waiting for a pullback, and also not choosing to invest into something else that does not have the proven track record, the fundamentals of the stock and fund like I shared today, Apple and SCHD. Waiting around could have had me missing out on gains. So I'm sticking to my plan. I'm continue dollar cost averaging even when these all-time highs hit. I'm building my portfolios for the future. I am a long-term investor. I'm not obsessing about catching the perfect price. I do invest on a regular basis, but incorporate having my alerts set and limit orders set and cash on hand so that I can go heavier on those red days. But overall, my strategy is about staying focused and holding great investments so that I can see them thrive and grow, increasing my portfolio over time. Having that drip on to reinvest those dividends, just striving to have me on track to build wealth. If you found today's video helpful, please share in the comments. What's one investment in your portfolio that you're still buying even though it's hit all-time highs? Drop any questions or comments you have. Make sure to subscribe, like, hit that notification bell, hype this video, and be on the lookout for more videos and live streams. Thanks for watching. Okay, bye.